Good morning, everybody. The heck of a move, huh? All right. So today, PPI did not seem to wait for us, right? Today's CPI is supposed to be the day that we were waiting for, expecting a sideways day Monday and Tuesday into CPI. I mentioned Monday how it was unusual to have PPI in front of CPI. We don't normally get that. And it seemed like the market really appreciated that early data ahead of CPI and played it to its max. Of course, a lot of people were looking at the 0 day, and the flows on the 0 day weren't even that robust compared to what we've seen in the past. So can't just off the cuff blame it on the 0 day flows either. Holding steady around the world, waiting on the CPI now. Markets in a tight chop, but the dollar and the 2 year have already started to fall out a bit. VIX back down below 20 puts us in just a pullback category. So want to keep our eye on that, make sure it doesn't get back above 20. But see the move in the dollar in the overnight, at some point, the market's just chopping across these highs, really not doing nothing. But the dollar gave out and the 2 year gave out. So that stands out to me this morning. Generally speaking, we've seen these be a front runner for an anticipated move in the market. I wouldn't try that this week. In the last few weeks, there's been days where the dollar, the 2 year, the S&P are all three moving in the same direction. So while generally an early move in the dollar and the 2 year to the downside would tell us the S&P is going to make an upside move, I wouldn't play that game this morning, right? Just wait on the data. There's no reason to try to guess or assume that we know which direction this market's going to go when we get the data. Japan down more than 0.5%, and Europe at a quarter. Everything else just kind of floating in between. Hong Kong at a quarter. It's interesting, the Russell's up a quarter while the S&P, NASDAQ, and the Dow are basically flat, all just holding at zero, waiting. CPI is the biggest event of the day. So anything else that comes along afterwards is still going to be considered less. It's Wednesday, so we got the crude report at 10:30. If we end up with a sideways market today, which I'm not necessarily expecting, then at least we could maybe find a move in gold or oil. So today we have this setup for a gap close play. I tend to bring this up on CPI days non-farm payrolls. This is what a liquidity gap looks like. And I get it. You don't see a gap. You see a candle. But it's called a liquidity gap. Price moved so far, so fast that the ceilings that it built overhead in the order flow are really new. They're really weak and they don't hold under any kind of pressure. And price goes back to the starting point. This was an 830 print, just like a CPI or a non-farm payrolls is going to be an 830 print. It's a single directional move. Notice there's almost no wick across the top here. It moved in one direction and it closed really far away at the end of the move. It didn't pull back to the halfway point. It didn't pull all the way back to where it started. After it built a base, it started working to get the gap closed. We got there about 11 o'clock. This is going to be a reoccurring theme. Same thing here. It's the 830 print. Single direction push. No real wick on the bottom side here. Closed near the top of the candle. It didn't pull back. We can tolerate a little bit of pullback, but if you break that candle into 4 parts, we want it to stay in the upper 25%, right? We want 75% of the candle to remain on the other side. After the move was made, worked its way back, got the gap closed about 10:30. 10:30, 11 is kind of what we're looking for. Doesn't matter which direction it goes, and all of these charts are on a 5-minute. Now, when it comes to a liquidity gap, this candle's appearance, you can find it anywhere on any time frame. Here's another one. This is a CPI one. 830 print. The first candle closed in the upper 25%. No real wick on the downside. And then it paused momentarily. That next candle held the line, didn't drop below that 75% mark, and just really digested within that wick. Then we continued on, built the base, started heading back to get the gap closed, got there a little before 11. I say watch the clock all the time. It's one of the best indicators you can use, and it's free. This is what we don't want to see, and I put some levels on there just to be able to point out where the 50% mark is. See how far we pulled back, left that big wick across the highs. There was also a really big wick at the bottom. We don't want the wick at the bottom if we're going up, or the wick at the top if we're going down. We don't want that initial drive in the wrong direction. We also don't want the candle to close below that 75% mark, so certainly nothing near its 50%. This was a gap close. It did get back down there really fast. This isn't what we're looking for. If it's not the right setup, it's not the idea that we can't trade, right? Though there's other setups that we can do. It just won't be the gap close setup. It's another example of what we don't want. Another CPI day. Big wicks in each direction. It closed almost where it opened. Not much of a gap close there. And the very next bar closed it. So this is not what we want. It's another example. This is not what we want, right? So it's very simple in its appearance. You can't miss it. And we have this possibility every time we have economic data, but we also get these opportunities in the intraday. There's plenty of times where we get these setups. This is one where we had 10 a.m. data. So Econ came out 10 a.m., gave us a liquidity gap. 12:30, we ended up getting some data, and we got another liquidity gap. That one was filled almost immediately. Then at 3 o'clock, we got another one, which dropped us down, closed the first gap, and then we ran right back up and we closed that gap. So when it comes to liquidity gaps, you can find them anywhere on any time frame. And like other gaps, we expect them to be closed. Now, there's always a question of, well, what if it doesn't close today? Because there's that phrase, that all gaps must fill. But this isn't a candle gap, it's a liquidity gap. And the reason we expect it to be filled is because of those weak hands, the floors or the ceilings that were created in the order flow, and the idea that there's no strength to that structure and it will just yield to price. Well, the longer the gap exists, the stronger those floors or those ceilings are, and the less likely it is that the gap will get filled. So something to keep in mind if you're thinking about a gap, liquidity gap that is 2 days old, 3 days old, right? The older it gets, the stronger it is. So earlier in the week, we were talking about pure price methods and how the market needs this move back up. We've got to get all the way back up to 5,600. Now, sure, we could pull back. That would set a lower high. But as long as we don't set a new lower low, then it would just be a pullback. And once we rise off of that, it would be a higher low. So we kind of need that, right? We can fail to get to 56 right now. That's okay. But in this pullback, we have to now stay above, call it 52, or, if we get through 52, the area of last resort, this low down here around 51.25. We have to keep that, because if we set a lower low, then we have the opportunity to leg down one more entire run. We would just measure this and we would plot that to the downside from wherever we round off here. There's a lot of talk from the weekly chart on this pin bar here and how the move that we've been getting is a dead cat bounce. We won't know for sure until we hit resistance, roll over, and begin to fall. And then we break through structure and we keep falling. Until that happens, we don't know for sure. I always like to find old examples, as it helps people who don't necessarily use price to kind of understand what it is that we're looking for. And that April move is a good example of how we ran up and we set that lower high, but we ended up putting in a higher low. And this low was kept, right? That's the key. We kept that low. And it was one of those where we fell down and we rallied back up and then made the move. Well, just like that pin bar that day when I told you guys it's exactly what we were looking for, a big drop down and a big rally back up and then a continuation. But we didn't continue, right? We got stuck in that range afterwards. And then finally, in the last few days, we've had that rally. So, okay, either way, that's our low. That's the level that has to hold. And we can pull back just like we did last time. But once we start to pull back, we'll be able to measure that high and low and mark the 50% mark. Once we get that level, it needs to stay above it. This one looks like it maybe broke a little below and then came back above. We can always just snap a fib on it and check, or snap a quadrant line to it. So it'd be the same idea. We can wick below it. We don't want to get below it and continue to expand below it. And there's really no reason to snap the lines yet from this high to this low, because we don't know if that's the high yet. We may continue driving to the upside again today. And if we did that, then this wouldn't be the level to mark. This will only be the level to mark if we fall away and we leave that behind, like a pivot point, something that looks a lot like that. Big candle up, big candle down. If that's what we get, then we can mark this as our high. That makes sense. Yeah. We are at the edge of the week's expected range. This is how far we were expecting to go for the entire week. I mean, we made that distance in one day. The gray line is where we closed on Friday. And on Friday's close, the weekly expected move said that we could move this far to the upside between Monday and Friday. The move was so big yesterday that we made the entire week's move in a single day. We are expected to close inside that box 68% of the time, which is a 1 standard deviation, or everybody just rounds up and says 70. Because it's the S&P, it has an overly accurate expected range. It's more like 80% of the time we're supposed to close inside that box. But in high volatility conditions, all of that gets thrown out the window. We're in the other 20% right now, right? Yesterday, the zero gamma and the levels for Thinkorswim didn't change. Today they did. We don't have the AM edition yet, which isn't a surprise. They're waiting for CPI very likely before they publish. But we're back above the zero gamma level and the volatility trigger. And I'm pretty sure they're going to have some kind of write-up that says we're back in risk on and we're bullish again. We're above the put wall, the volatility trigger, the zero gamma. We're above all structural levels. And I'm pretty sure their write-up is going to say that we're now focused on the call wall as resistance and that everybody is looking at that call wall to be rolled up. As price gets closer to the call wall, each day we would expect it to get out of our way and get rolled up by investors. We don't have that yet, and we don't have their report yet. So no reason trying to base our analysis on what we think we're going to get. We can just wait for them and see what we get. The distance from the weekly floor pivot is starting to come into play. I don't have a specific level that says we've gone too far. I've tried to quantify how far is too far when it comes to these weekly pivots, and I'm not having any luck. There is a distance, however, that we get to where it really seems like we've put in about as much distance as we can get. And if the market tries to go farther than that, it just continues to get rejected again and again and again. Last week, for an example, we got a considerable distance from the weekly pivot point, and it wasn't tested again. That was as far as we got. The weekly pivot is at 52.90. Let's just round, make it easy. And we're at 54.60. So not quite 200 points. I think we've seen more than that before, right? Should be able to get 350 before it starts to get into the extremes. And while yesterday was a big move, don't think that we can't get another big move today. That's a fallacy, right? It's a misconception. It's easy to remember all those times where we made a big move one day and we didn't follow through with it the next day. But if they want to run it today and everybody tries to short it, all those shorts will add to the fire to the upside move because those shorts have to cover. They add to the buying. It's just more buying. It adds more buying and more buying, more buying. So I'm not saying we're going to make another big leg up today. I am saying don't think we can't make another big move today because we can. And it is worth noting on that daily chart, that reversal that I pointed out with a very big move up, and the very next day, an immediate, complete unwind of the entire thing right back down again. Well, that can happen too. So it doesn't have to be two big up days. It can be one big up day one direction and one big move down the next day. There is a lot of argument to the idea that in a bear market or in bear market conditions, markets can bounce and move violently to the upside, and it can appear to be an amazing recovery rally right up until the time we roll over and continue the next leg lower. That has to be taken into consideration, right? The VIX is still elevated, although it is in the area where it says the market is just in a pullback, that we're not, in a more deeper correction. But the VIX is just a window, right? It's just a snapshot into SPX options volume. We have to wait on price to give us the next signal. And unfortunately, the next signal is either getting through this high at 56 or pulling back and maintaining higher than 52. We have to pull back, set a lower level, a higher low, and then come back up and break this level. Anything else that we do before we get either of those signals, this break above 56 or a pullback that stays higher than 52 and then rallies up and breaks this, anything else is just us guessing and waiting, because we need one of these two signals to happen. Until we get it, this could still be a dead cat bounce. It could still be just a sharp rally in a bear market where we roll over and continue the next leg lower. There's absolutely no way to tell until it does one of those two to be able to say which one this is. We have an MDP today, but it doesn't count until tomorrow if we can make it through the whole day today. An MDP is a missed daily pivot. We haven't hit this pivot point, so thus it's an MDP. It's a really wide channel, and it's outside of yesterday's channel. The fact that it's really wide implies that we likely don't make big moves today, but it's a day-to-day, right? Day-to-days we can make big moves. And the fact that it is above yesterday's channel completely would imply bullishness, especially with the fact that we're above the pivot as well. Also implies a bullishness from a continuation standpoint. The R1 level is 54.88. So we've got a ways to go even just to get to R1. Since we're basically flat, we're no closer to one edge than we are the other, and we're really tightly wound within the VWAP structure. This is just reciprocation, right? Back and forth, like a really tight, like a zipper. Or railroad. I've heard it called railroad before. Just a very tight structure, waiting on data. The longer we stay like this, the more energy we're building up, by the way. It is worth noting the numbers just like yesterday. Our daily range right now is more than 100% of the daily expected move that the options have priced in. I mean, when it comes to the door, I'd like to see more out of it, but the door and the futures have been really disappointing. The door on equities has been great, but on the futures, it's been about as good as anchoring the VWAP off of the contract change, which which hasn't been very good either. So it's worth marking out that halfback, certainly, since it had that double candle anyways. So there's likely a lot of structure there, and it's like an engulfing bar from that other big day. So sure, it's worth catching that. 55.32 cog line to me would probably have more value, but that would be an overshot from 55.22. So that works. I've just been really disappointed in the door when it comes to futures. I really think that's an equities concept, and the more I use it, the more I'm convinced that it's just equities, which is okay, right? I guess we can't have it all in the futures. I guess we got to share a little bit of the fun somewhere else. Volume's light. It's not too light, too dangerous. Monday was lighter than it is today. And there's no market maker move. That's something that stands out this morning. Like they're not worried. And I really, this takes us back to PPI yesterday. Normally PPI comes in after CPI. And I think there was something in the data yesterday that makes them a little more confident about today. Confident enough that they're not hedging. Confident enough that we saw the dollar and the 2-year move already. We're above the 10-day, the 10-week, the 3-week, the 20-day. We've got a lot of structure now underneath us. And we're back above 0 gamma, the volatility trigger, the put wall. I think if we did try to go down, that there's a lot of structure down there that's willing to be there to catch us and hold us back from a continued move to the downside. Point of control, 53.66 area. We're building out some structure at our current location, but it's very narrow. It's a little bit of a warning in that. You know, like we run up into a ceiling and there's a lot of sellers sitting here just loading it up. Really nice bell-shaped curve. And we have a new point of control that was developed yesterday in a classic P shape. At least it would have been a classic P shape. We don't need this one anymore, so we'll just actually, you know what? That one's still good. So now we have 2 underneath this. That's close enough, huh? Yeah, it's close enough. Either one. 49.5 or 49.25, either one. We've got that to the downside. 54.72 to the upside is a VPOC level from a while back. I think it's within this contract. Yeah. July 15 or July 23rd. So we still have that one. I don't see us getting there. I was focused on the wrong one. We can get the 54.72 today. We can make that one. But this other one, this 56, we're not getting up there today. So we had a lot of volume around that morning session where we're building out some good structure here. Then we got into 11 o'clock and away we went. The amount of volume we got across the highs yesterday really showed the sellers. Now, was it just liquidating positions from the day run, right? We can't really assume that we know everything that was being traded up there. But either way, it was a lot of volume across the highs. And if it wasn't for this area of volume, we'd say this was a really good P-shape profile. Instead, we have two Ds and it's more muddy. Still, a break to the downside would put us into the VPOC, and then we could come down and challenge 54.11 cog line, which is the high value node down here, high volume node. So we will be looking at that level for some structure if we make this break to the downside. 54.11 high volume node and a cog line. So as with data points, sometimes the data is a little muddy and we don't really get a response. But there's a lot of times where we get CPI and the market makes an immediate move that lasts for days. There's other times, right, where we really just don't do anything for days and something else moves us later. So we don't have to make a big move today, but when everybody's waiting on this data, it can move markets and it can move them for days. So something to think about. It's not just today's play, right? %1 above the 10-day and 1.5 is about our norm. So we would expect to kind of balance out somewhere around 1.5% above the 10-day. Now that's reading candles that are closed, right? That isn't telling us whether we overshot 1.5 and then came back down and closed around 1.5. So, kind of keep that in mind, right? All of these readings are from end of day candle close levels. This is telling us, by the way, that we're not overbought, that the move yesterday wasn't so big, so aggressive that it owes us some sort of pullback or mean reversion. Did we travel too far, too fast? No. Looking at the 10-week, we're not even 0.5% above the 10-week. We're still within the range of choppiness where we could just crisscross back and forth above the 10. It has no structural support, right? Normally we'd look at the 10-week and we'd say, oh, that's support. Not after we've been crossing back and forth through it. There's no respect for it now. It's not support. And we can cut back and forth through the 10 as many times as we want. It's still not going to be something that we want to look at for any sort of structure. We have to leave the range first and then come back to it before we would have any expectation that it might support the market. This is also telling us we haven't moved too far, too fast. We're not overbought. We're not overextended. And it doesn't owe us a pullback simply because of how far we've moved already. So if you're thinking, I'm going to short this sucker because we made a big move yesterday, this is saying that's a bad idea. If you have other reasons to short it, then this doesn't have any impact on those decisions, right? least squared methods, dot plot statistics, standard deviation, bell curve. It all says the same thing. We didn't move too far yesterday to expect a pullback simply because we moved a considerable distance. And looking at the sectors across the board over a 5-day period, everything is green. So it kind of goes into the argument that this pullback that we experienced over the last, 2 weeks or so, this has simply been a pullback that got a little bit out of hand, and it went a little deeper than we would have expected it to, but that it's still a pullback and that we're not going to continue moving to the downside in bear markets and blah, blah, blah. There's a lot of investors right now talking about 1995 as a period in history where we had really high interest rates. The Fed started cutting, and the correlation of how the market reacted back then to the way they're anticipating the market could react now. So if you're looking for some homework, something to go study, kind of for an expectation of what is markets expecting when it comes to, corporate earnings and how much the indexes moved and which indexes did good during the cut or during the cutting cycle. 1995 would be the area you want to focus on. Alan Greenspan, right? I know all of us old people are like, yeah, I know that name. And the younger people are saying, whatever, dude, don't know that. I get it. Really no reason to take a look at what is up or what is down gap wise on the equities, simply because once we get the data, anything that is up can go down and vice versa. The ones that are up because of events, they're very likely going to ignore whatever news is out on the CPI, PPI, and they're just going to do what they're doing. Like Google, there was this is probably a good one. There was some rumor about Google getting broke apart as a part of their punishment. That dropped the stock this morning. That's an easy layup. What's the likelihood that they actually are going to try to break Google up? It's one of the possibilities of what could be imposed, but there's, possibilities with a high degree of likelihood, and then there's just speculative possibilities of what are my range of options on what could happen to Google. And that's one of the range of options of what could happen to Google. But is it likely? I don't see it as likely. If it's not likely, then Google popping back up after the decision is made and maybe they get their hand slapped, maybe they have to, let others into the space, but they don't get broke apart. That might be a nice rebound to play. Kellogg had news, or Kellanova. They split last year and became Kellanova. Now they're getting bought by Mars, Pringles. So what? You're gonna have Pop Tarts and Pringles, but the move has already happened. The share for the M&A was around 80, and hey, we're at 80 already. So no surprise there. Don't see much follow through on this, and don't see it holding those levels either. So it might be a nice play in the other direction. It's kind of a slow front this morning, right? There's just not a whole lot out there. There are things that are moving. There's always things that are moving, but I would focus on the ones that had some sort of news or event to it, something that actually caused it to be up this morning. Earnings, M&A news, upgrade, downgrade, something other than just, oh, hey, look what's up this morning. Because those kind of grinds are likely going to flip as soon as we get data in 19 minutes. Pring tarts. I like that. Yeah. I I don't know. I like food. I'm certainly not one to turn food down, but not a big fan of either of those. Certainly wouldn't want them together. Bitcoin is up this morning with semiconductors barely. It's got a 0.5%. China's down. The China ADRs through the K-Web is down. Just not much on that side. We're waiting on data. I think that Starbucks play will be a nice short too, but it needs to start the move first, right? Uranium, Bitcoin, small caps, agriculture, pot stocks, semiconductors. It seems like a pretty broad rally, right? Which kind of leans towards the continuation of yesterday's move. But we want to make sure that CPI isn't going to throw cold water on that entire hot move. And so get the data, then we'll see where we go from there. It isn't hard to lay out the plus and minus for the day. Whether we use the ADRs or just lay out some simple math based on previous levels. But the ADR levels are there. 5405 and 5505. If we just round and make it easy, right? It's a 100-point range because it's supposed to be a 100-point range, or 100 points in one direction. So from where we closed last night, which is basically where we're at now, a 100-point move to the downside, that'd be 53.50, and a 100-point move to the upside, that would be 55.50-ish, right? Just round it. Easy number. 100 points in either direction. If you wanted something else, then start with yesterday's range. Use the highest point to the lowest point within the regular trading session. That's one way to go. And or use the entire trading range. It's the other way to go. Now you've got your sell zone across the top. If we get through that sell zone, then we made it through liquidity, then we have a breakout that's got legs, just like yesterday, right? When we drew that sell zone across the top, we knew once we got through that sell zone that we were through the liquidity. The whole thing is based on how you have price that sets a top, and then it comes back and it sets another top. Well, double tops are bear traps. Liquidity resides on the other side. So we expect price to get through the previous high and then get into that liquidity and get rejected. If it doesn't, however, when you have price that set a top and we roll around and we come back to that top and we overshoot, at what point do we decide that it's no longer a double top and it's actually a breakout? We need this zone or level. So that's what we had marked out yesterday, that zone or level. Once we get through that level, then we're above the sell zone and it's game on to the upside. So we have our sell zone right there. If we get on the other side of it, then we can start focusing on 50% of the move, which gets us above the roundy. It gets us through 54.92 cog line and just continues our move into 55.11 cog line and this trend line. From the weekly. Otherwise, a move to the downside, 54.11 cog line or the halfback of yesterday. And I would want a halfback from just the RTH. So from yesterday's intraday high to yesterday's intraday low, I would want that halfback as well, right? I missed that top, but you get the idea. That half back is 54.31 cog line. Imagine that. Perfect. We would have been watching that level anyways, even if we hadn't measured that out. So what I got for you guys today, watch the clock, keep your eye on the news, look for clues that this continuation is going to actually continue. Don't just assume that it won't. And see if we get a gap close play. Everybody be careful, be safe.